Good morning again, everyone. Thank you for your patience. I'd like to extend a warm welcome to you all. Thank you for taking the time to join our earnings call presentation today, where we'll be discussing the results for the second quarter, which ended on December 31st, 2024. My name is Nicolette Bailey, and I'm a member of the Investment Management Unit here at SYGNUS Capital. And it is my pleasure to be your moderator for this morning's presentation. Now, I just like to encourage everyone, all the information that is presented here this morning, please read in conjunction with our management discussion and analysis, which can be found on both the Jamaica Stock Exchange website and the SYGNUS Group website. Additionally, if you have any questions during or after the presentation, please share them using the Q&A option in Teams. After the main presentation, we'll have a discussion segment where we will go through all your queries. Now, I'd like to welcome our presenter for this morning, Mr. Jason Morris. He is a co-founder, Executive Vice President, and Chief Investment Officer at SYGNUS Capital. Over to you now, Jason.
Hi. Thanks, Nicolette. Good morning to everyone. Give me one moment. Okay, so as Nicolette stated earlier, we'd like to give you some insight on SCI's financial performance for the second quarter ended December 2024, as well as for the 6-month period, also ending December 2024. So without further ado, let's jump right into it. Starting with the first slide, which is the dashboard. Just want to give you some backdrop in terms of, the things that lay the groundwork for the financial performance. So the 6-month dashboard, 6 key items, just to give you that kind of backdrop. The first one is dealing with core revenue strength for SCI, where the company would have generated 8.7 million US in total investment income. And this should be seen in the context of at the start of the financial year would have indicated, I think at the last AGM, not this one that just that the one that just would have just been concluded. But in 2024, the 2024 AGM would have stated that we have a goal to try and get to 12.5 million US within, I think, a 12 to 24 month period. So we are well on our way at 8.7 million US at only the 6-month period for 2024-25 financial year. So hopefully we'll be able to hit that target. So this is just giving you that context that in terms of the core revenue, which is what we use to pay dividends from, etc. We are so far performing as we expect. Second item has to do with one of the reasons for the first item, which is the transformation of Puerto Rico. I should now start to classify this as the continued transformation of Puerto Rico. If you all recall, for those of you who were on the Q1 earnings call, we went into great detail to explain how Puerto Rico was being transformed by 2 key initiatives. One of them was to reorganize the company from a corporation to an LLC. And the second one, of course, is restructuring how the company operates by removing the management, changing the company from an internally managed entity to one that's externally managed, which means that the operating expenses of the company would be pretty much a function of the growth of its balance sheet. And that would allow the company to do a lot more originations and execution of transactions. And that continued during the second quarter because the company would have delivered record net profits of 3.1 million for the 6-month period, which is the highest by far in history, and would have also delivered a a Q2 record net profit, which also is the highest Q2 net profit in its history. So the transformation of Puerto Rico continues. Third thing is deployment. As a private credit company, the lifeblood as a company that's invested in credit is you have capital you need to deploy it and have a robust pipeline of transaction. So for the 6-month period, we have deployed 60.1 million. And in particular, for the second quarter, 35.29 million. And this is for the entire platform, both SCI and the Puerto Rico platform. Fourth item, which is very familiar to everyone if you were on the AGM call, is the funding that SCI would have launched during the month of December and raised the equivalent of 33 million US from perpetual preference shares via the Jamaica Stock Exchange public market, which is the largest raise in the history of the JC for a perpetual offer. Fifth item is shareholder dividends. During the quarter, would have paid 1.6 million US in dividend, which is the highest equivalent dividend that would have paid since the SCI would have started paying dividend after becoming a public company. And the last, but by no means least thing, is to highlight the fact that as part of our initiative or strategy, which we'll get to when we get to the last slide, was we needed to generate over 10% in return on average equity. And for the 6-month period, we would have hit that milestone. And we are pushing very hard to continue to get to the end of the financial year with a double-digit return on average equity. Of course, as we all know, everything doesn't operate in a straight line. So the number may go up or down, but we remain resolute to try to get there. Now, to jump into the performance for the 6-month period and for the quarter. For the 6-month period, SCI would have achieved new milestones for net profits, total investment income, and net investment income, which were all records. For the net profit, it was 5.13 million versus 2.28 million in the 6 months for the same period last year. And total investment income was a record 8.74 million versus 4.15 million last year. And just a note here that total investment income was primarily driven by the performance of the Puerto Rico business, which would have resulted in an SCI's income statement, a flow through of 4.43 million US from the Puerto Rico Credit Fund. And I'll get into a little bit more detail in another few slides on that to explain that to you, just like what we would have done at the AGM, because it's very important they understand how the transformation of the Puerto Rico business is going to affect SCI on a go-forward basis. And just to highlight here that over the last 6 quarters, since we would have started the aforementioned transformation of the Puerto Rico business, that business would have generated net profits of 7.24 million US. And what would have been reflected cumulatively on SCI's income statement is 5.74 million US. So there is a little gap, notwithstanding the fact that SCI only owns 95.58%, so we don't own 100%. However, the difference of 1.5 million is due to timing differences in terms of valuation, which utilizes market metrics to adjust the net benefit that flows through the SCI. And I'll get into this a little bit later. From a net investment income point of view, that was also a new record, 6.42 million versus 2.06 million last year. Earnings per share, 0.88 US cents, which is 0.88 US dollars, which is a record versus 0.39 last year. And the net investment income per share, 1.10 versus 0.35. Now, for the 6-month period, net profit was down, registering 203.79 thousand versus 1.53 million in the similar period last year. And the net profit was down primarily due to the fact that SCI would have registered a wild swing in investments measured at fair value that had unrealized losses of 1.62 million. In the management discussion and analysis in Q1, we would have registered, I think, 1 million positive in unrealized fair value gains. And at that time, we would have put a note in the MD&A, if you go back and look at it, that says that the fair value gains on these instruments can swing wildly from quarter to quarter, which, as it turned out, in this quarter, it has completely reversed. At the end of Q1, when the Fed would have done the first rate cut and markets were pricing many interest rate cuts on a go-forward basis over the next 12 months, that kind of resulted in the fair value instruments getting substantial increase in valuation based on the market metrics that we had to use. And subsequent to that, when we get to the end of December quarter, the trajectory for US rates has changed somewhat. And in incorporating those changes along with our own perspective of the performance of the underlying companies that carry these, that have to be valued at fair value, we would have had an unrealized loss of 1.62 million. So this unrealized loss effectively changed the trajectory of net profits, because if you look at total investment income, which is the top line, our core revenues, that was a record 3.65 million, but the 1.62 million would have primarily been the driver of moving that down from profitability, from higher levels of profitability to the 203.79 thousand that you saw here. In terms of net investment income, that was also a new record of 2.59 million versus 1.51 million last year. So both total investment income and net investment income were up substantially, again driven by the Puerto Rico business, which would have delivered a Q2 record in its performance. Earnings per share for the quarter was thus 0.04 US cents versus 0.26 for the same period last year. And net investment income per share, however, was a record 0.45 US cents versus 0.26 last year. Again, net profit was affected by this swing in fair value gains moving to fair value loss in the quarter. And on a go-forward basis, this could swing again. Again, these things are market determined. Some highlights on slide 6, I want to highlight a few things just to give you more context for the financial results. I'm not going to go through this slide. The first thing I want to highlight is interest expense, which for the Q2 was 3.33 million versus 2.09 million last year. And likewise for the 6-month period, 6.37 million versus 3.96 million. So for Q2, interest expense would have reflected a little bit higher interest costs because we had quite a number of transactions in the pipeline that we needed to fund. However, we were in the process of doing our capital raise, and what we chose to do is, rather than lose out on those pipeline opportunities, we effectively took out bridge financing to bridge the preference share offer. And of course, bridge financing cost is substantially higher than the cost that we would have raised the preference share at. And so, because these are, even though they are short-term bridge notes, the cost of the capital was high. And so for the second quarter in particular, we would have been carrying kind of higher interest-bearing bridge financing, which meant that our interest expense was higher than it would otherwise have been. And this pretty much resulted in us being slightly down. I mean, we're 1.82 million in net interest income versus 2.18 million for Q2. And so the reduction there in net interest income would have been driven by the volume of short-term bridge financing that we took out that was substantially higher than what our carrying cost of capital is. And that also dragged down the six months net interest income by that higher interest expense showing up in both the Q2 and the 6 months, affecting the Q2 numbers, affecting the 6 months figures. So for 6 months, you see 4.12 versus 4.3. So that 200,000 being behind would have reflected those higher interest bearing liabilities. Second thing I want to highlight is participation and commitment fees. 144.5 versus 210 for the quarter and 164.6 versus 272.8 for the 6 month period. We would have had particular transaction which we would have generated undrawn fees on, which is about 125 to 130,000 thereabouts, give or take. Which if we adjust for that, we would actually be making, generating higher participation commitment fees than last year. But that transaction did not recur this year, and we have other transactions which we may generate undrawn fees on, but these are kind of ad hoc in terms of generating those types of fees, which is very different from commitment fees. So from a commitment fee perspective, we are performing as expected, but that 125 to 130,000 undrawn fees with that specific transaction, I don't want to say it's a one-off, right? Because we are in the business of generating those types of fees, but they occur kind of infrequently. Third thing, just very briefly, you can see in Q2 and the 6 months, the performance of the Puerto Rico Credit Fund investment income, how SCI is starting to reflect those performances from the Puerto Rico business. And hopefully within the course of this calendar year, we will start to receive dividends from the performance of that business. Other thing to highlight here is the fair value gain or loss. As you can see in Q2, that big 1.62 million swing, which from Q1 it was actually a 1 million up. So you see that for the 6 month period, we're actually down 670,000 to the fair value loss, which is unrealized, because that 1 million that we registered in Q1 has been completely reversed. And some net FX also 306.4 thousand. The currency would have appreciated marginally, somewhat. Would have, well, it certainly would have, relative to when we did transactions. So the currency would ended at 155.60, started at like 155.59, but during the quarter it would have gone close to 158 mash, and then come back and we would have done transactions, put transaction on the balance sheet at 158 mash, right? So appreciation means that we have this unrealized swing that you're seeing. But needless to say, since the end of the quarter, the currency has actually moved in the other direction. So maybe by Q3 numbers, we will see a reversal in this. And finally, impairment of 361.98, 361,000, well, call it 362,000. This is primarily reflecting a stage 3 asset that we already have on the balance sheet in the mining sector that would have taken an additional charge of about 200 or so thousand. So we can move to the next slide. Spending a few minutes here I know I spent a lot of time on this in the AGM, but just in case you missed it, the way we read this chart is from the bottom up. So the first column is just showing you the different companies, and the important company to look at here is SYGNUS Financial LLC, which is the operating company that SCI would have acquired in 2022. So moving to the second column, you see that the operating entity would have achieved 3.07 million in net profits, and that compares to 1.34 million in net profits for the similar 6-month period last year, and that's up 129%. So phenomenal growth and performance. Congratulations to James and the management and the entire team in Puerto Rico for phenomenal performance. Now, we have a holding company that sits on top of SYGNUS, which is SYGNUS Credit Investments Puerto Rico Fund. And the profits from SYGNUS would have flowed up there and generated 2.86 million consolidated at that level, which is up 113% from the 1.34 million last year, right? So far, so good. However, to get the number to SCI, where you see the 4.43 million, 4.431 million that is reflected through the SCI's financial, we have to do a market valuation using controlled premiums and price to book valuation metrics. So the 2.86 million would have translated into 4.43 million in terms of the 95.58% value that flows up to the SCI. And this compares with a loss of 437.33 thousand that we would have reported for the similar 6-month period, same time last year. So last year on this very earnings call, we would have said that we would have reported a loss on the Puerto Rico transaction, but I also said at that time that the loss was not because the Puerto Rico business made a loss. So if you look at what happened last year, we had 1.34 million that flowed up to SYGNUS Credit Investments Puerto Rico Fund, right? But when we did our market valuation of it, it already reported, it was recorded as a loss of 437,000, which if you look at that number, that's a swing of about 1.7 million to the negative. This time, we have a positive swing. So these things will continue to kind of move, vary a little bit in terms of timing differences. But the key thing to note, as I said before and 2 slides ago, was that the business has generated over $7.5 million US in net profit, and only 5.7 million or so has actually flowed up to SCI. So SCI is still not getting the full bang for the buck, so to speak. Next slide, looking at the performance for the quarter for the Puerto Rico business, similar thing is happening where SYGNUS generated a record Q2 earnings of 1.48 million versus 950,000 last year. When you flow that up on a consolidated basis to the Puerto Rico holdco, it's 1.38 million versus 950,000 last year. But then to get it to SCI, what flows through to SCI's income statement, 1.76 million using the market valuation metrics versus the 102,000 that would have gone through the income statement for the Q2. So the Puerto Rico business continues to do phenomenal. I would expect the performance to continue for the remaining 6-month period of the year. On to the next slide in terms of efficiency and expense ratio. For Q1, if you recall, we were out. Our efficiency ratio was above. I think it would have been like above. Well, certainly we're outside the 40% threshold. For Q2, we have firmly fallen back within the threshold at 26.5%, and I discussed this at AGM and on the Q1 call that we expected to fall back within the efficiency metrics. And this efficiency metrics again is simply for every dollar revenue that we generate, how much of it is going out in expenses, and we want that to be less than 40%, so that we have that money to either redeploy into new investments or to pay out as dividends. And from our operating expenses to total assets under management, That is at 2.1%, and the threshold that we have is for 2.85%. So we are well within those expense ratios, which is good. From balance sheet perspective, shareholders' equity is now 75.62 million, which is a new record, I think, up 7.3% versus similar period last year. So in effect, SCI has 60 million US in shareholders' equity, and we at 75.62 million in shareholders' equity, 60 million in share capital, sorry. So at 75.62 million in shareholders' equity means that we have roughly 15 million in retained earnings carrying on the balance sheet. And what this does, it strengthens SCI's ability to navigate any type of economic shock that may come down the pike. So that's how you should always interpret the shareholders' equity. Total asset is now a record 217.81 million, up 5.4% versus the 206.63 similar period last year. And these numbers do not yet reflect the capital raise that would have occurred in December, because the closing of the transaction would have formally occurred in terms of the recognition of the balance sheet in January. In terms of balance sheet KPIs, debt to total assets, asset coverage ratios, net debt to equity are all substantially within the targeted guidelines of 0.5 for the debt to total assets, greater than 1.5 for asset coverage, and less than 1.25 for net debt to equity. And non-performing investments was 0.6%, well within the 5% threshold level, and compares to 1.1% for the similar period last year. So we continue to ensure that the balance sheet remains strong as we gear up to transform and expand the business further. Now, very briefly, look at investment activity. At the end of the quarter, investment in portfolio companies now 206.7 million, but this includes 33.1 million reflective of the Puerto Rico Credit Fund and 1.47 million of an investment that we made in another Puerto Rico entity, which is a business impact fund. Portfolio companies, 37 versus 35 last year. New investment commitments during the quarter, 20.85 million versus 4.44 million last year. They would have had a quadrupling of transaction activity. And this is why we would have taken on the bridge financing to bridge the perpetual preference share, because we didn't want to lose out on $20 million worth of transactions while we wait on the closing of the preference share offer. Fair value yield, 15.2% versus 14.6%, tenor 1.6 years versus 1.7, and dry powder was a meager 2.91 million. Of course, we were waiting on the perpetual preference share offer to close. In terms of dry powder activity, we continue to document the $10 million transaction from World Business Capital, which is guaranteed by the United States Development Finance Corporation. So we continue to work on that to get it to close. From a risk management perspective, stage 1 assets, which is the bulk of the transaction on the balance sheet, 99.8%. When you look at it net of expected credit losses, 99.1%. We look at it in terms of amortized cost assets. Stage 3 still reflect full restructured assets at 1.3 million US versus 1.78 million for the similar period last year. For one of the stage 3 assets that we have been speaking about forever, seems like forever, it's almost 3 years, or 2.5 years thereabouts. We are still in the last mile, very long legal exercise, but we are closer to getting closure to the transaction. Let me stop saying that we are, that we are in the 9th inning because I've been saying 9th inning for like 2 to 3 quarters now. But we're pretty close. So hopefully I'll be able to come at some point in 2024 and give the good news to say we have recouped our investment and we have closure. The second stage 3 asset, as discussed last quarter, we are exercising our powers to recover or recoup our investment from that. So that's a legal process that began last quarter and continues this quarter. When I have more to speak about that, I will say that. For MB Cayman assets, I don't have any additional note on that. As I said during AGM, it's a low probability recovery of any recovery. I've already taken the entire hit on that transaction, and I'm not expecting anything to come back. If something comes back, then we write it back to the balance sheet. But our expectation is I have very low confidence in that happening. Next chart showing you the ECL charge now at 1%, having added 20 million to the balance sheet in the last quarter. Of course, expected credit loss as a function of our private credit portfolio, still within our tolerance level. And of course, as I said before, we would have taken an additional charge and one stage 3 asset during the quarter, which kind of helped to bump this point from 0.9% to 1%. In terms of allocation per industry, we're still very well diversified across 22 industries when they include the Puerto Rico portfolio. So we don't have a diversification issue. We're very well diversified and we expect to remain this way. The 2 largest exposure from a industry level is really construction, which is primarily being driven by the Puerto Rico business, given the mandate for reconstruction in Puerto Rico and the tax benefits that arise from that in the Puerto Rico jurisdiction. And the other one is financial services. And a lot of these financial services also reflect pure investment holding companies who are executing transactions across multiple regions. From an allocation per region, Puerto Rico remains the largest exposure, 30.3%, Jamaica, 25.6%, a very close second, Bahamas, 14.9%, St. Lucia, 12%. So we are quite diversified across multiple territories, and we intend to remain so. Of course, we still have a few transactions in Panama and Mexico that are still being closed out. We inherited those when we did the acquisition of Puerto Rico. Final slide, looking at update and strategy. 4 pillars to the strategy as usual. The first one is, as we highlighted in 2023 earnings call, our AGM, which is to really dominate the Puerto Rican market. And I think we want to be number 1 in Puerto Rico. That's our goal. And so far, so good. The business is scaling. And that's being reflected in the volume of transactions that are being done, as well as the level of profitability of the business. And as I keep saying, this business will soon start paying dividends. And so that benefit will flow straight to shareholders. So doubling the profitability in Q2 and doubling profitability for substantial increase in profitability for 6 months. We can't ask for better than that from the excellent management team in Puerto Rico. To aid in this, of course, you need dry powder, right? It's lifeblood of private credit companies. And the Puerto Rico business has a substantial increase in dry powder. They have a line which is $100 million US right? So just think about that for a minute. Well, they are in a very large economy. Puerto Rico by itself is bigger than GDP, is bigger than all of the Caribbean territories that SCI is invested in combined, right? So we're happy to have made the investment and increased our investment in Puerto Rico. We're now seeing the benefits of that. Second thing, that's going to SCI's strategic growth path. We're over 500 million US in private credit transactions across the region now. So we have another 500 million to go. So it's, success beats success and the work never stops. Core revenues were 8.7 million in half year. Our target was to get to 12 and a half within 12 to 24 months. I think we are on course. So let's see if we can exceed that 12.5 million. Return on equity, to get that to consistently be above 10%. And so far for Q2, for the 6 months, we are at 14%, even though the Q2 result itself would have been affected by the wild swing in the fair value unrealized losses. But that's par for the course. The key thing for us is whether or not the total investment income, which is the top line revenue, is growing and growing strongly. EPS, to try and get that to grow at 20%. So far, we have done 18.4% for last financial year. And so far for the 6 months, we are substantially above that. So we have to just keep pushing to see where we end the financial year. And then the 5% dividend yield and APO price, steady state, I think we are above that. Speaking, and the regular yield on the stock is 7.5% as of last Friday. I already went through this in great detail at the AGM. So, I'll just double down on what I said then, which is if you can go in the market and buy a US dollar dividend paying entity that's giving a 7.5% yield, that sounds like a good deal to me all day, every day, and twice on weekend. Dry powder for SCI itself, the Puerto Rico business already has its vast increase in dry powder. Dry powder increased by about 40 million. We're trying to get, and that's a line, right? That's a revolving credit line. So in addition to the 10 million WBC facilities that we're still pushing through, of course, I know that people are going to ask a question about whether or not the new administration in the US is going to affect this DFC transaction. We don't think so. We think this transaction is still going to go ahead because it predated what's happening now. But let's see where we end up. We are pushing to get it through. The pref share is there, of course, but we are still pushing aggressively to try and get a big revolving credit line. Maybe it won't be as large as the 100 million that Puerto Rico has, but we are trying to get something that's substantial. So when we have more information on that, we will inform you of that. So basically, this is in addition to other financing that we were seeking to get to 100 million, right? So we are still seeking other facilities similar to what we have with World Business Capital and DFC. And we have some multilaterals that we are discussing that with, and those talks will continue. But we are now saying that we need to get a large revolving credit line, which is what you call a warehouse facility for SCI. And we would have, started those discussions in earnest in February. Because to scale the business and to grow, we need ability to have dry powder on call that we can utilize and then put back that money and then draw on it again as we have a need, because we are seeing substantial pipeline activities, and we feel that based on where SCI is at the moment, with the type of capital that SCI now has, with the successful conclusion of the perpetual preference share, which will strengthen effectively the proportion of equity capital that SCI has, which should get to close to 100 million. Then in total equity, then it's time for SCI to go up another level to scale the business. Third thing is new business. We're working on a particular transaction for a dedicated financing solution in a particular Caribbean territory with a strategic partner. And this will enhance SCI's earnings power and help to anchor the core revenue growth that we spoke about, anchor the return on equity to maintain that in double-digit region on a consistent basis, anchor our target to grow earnings per share at 20% per annum, anchor our ability to have a 5% minimum 5% dividend yield on the APO share price. So we are pushing very aggressively on this to try to get to by in another 3 months or so to get that to be up and running. Final thing is share buyback program. I have nothing to say other than the share buyback program remains in effect to its fullest extent, as we would have communicated when the program started and as communicated at AGM. Thank you very much. We'll now take questions.
Thank you for that detailed walkthrough, Jason. As you would have shared, we'll now address any questions that you may have related to the presentation or our operations. You can use the Q&A option in Teams to share your questions. I'm not seeing any questions as yet, but in the interim, I'd just like to encourage everyone to read the full MD&A report, which can be found on both the Jamaica Stock Exchange website and the Investor Relations section of the SYGNUS Group website.
Okay, there are no questions?
No, not seeing any. I suppose if you do have any, we can also address them via our inbox at info@SYGNUS Group if it should come after.
Well, let me answer one question that was asked on Q1 earnings call that I didn't answer fully. Well, what I basically said was that I would get the answer and come back with it, right? And I don't think I did. So the question had to do with, I think, the cash flow statement, SCI's cash flow statement, where there's a line item that refers to other operating costs paid. And in the Q2 results, the other operating costs paid right now is $5,486,339 US dollars, and this compares with $2,235,646 for the similar period last year. So in Q1, the number was similarly over 100% higher, and I was being asked what's driving those operating costs and those expenses. Why are our expenses so high, right? And I think what I'd attempted to do was to say that this had to do with a new accounting classification. So basically, I think the way that line item in the cash flow statement is classified, it's kind of I don't want to say it's a misnomer, but it maybe the description is a bit wanting. This is a new accounting classification that is coming on stream, and we are basically early adopters of it. I think everybody will have to start reporting this way. But the long and short of it is that the other operating costs paid is actually not cost, because inside that figure, for the current reporting period, we actually have the profit for the period of 5.127 million, which is adjusted for interest income, which is 10.49 million, interest expense 6.9 million. So net interest income then is actually bundled up in it. You have the provision for expected credit losses of 414,000. Then you have the fair value losses, unrealized fair value losses, 3.847 million is in there. You had other receivables of 740,000. Due from related companies, 524,000. Then you have accounts payable and other accrued liabilities, 4.577 million, right? And due to related companies, 954,000. So when you take all of those different items and net, then you get 5.486 million versus for the similar items for the same period last year, 2.235 million. So these are not actual expenses. It's just many different cash flow items that are being adjusted, against the profit for the period. So I know that it's a new way of reporting since the Q1 results, and it probably confuses persons. So maybe what I can do for the next MD&A is to actually itemize this specific thing inside the MD&A and just create a table to itemize what those things are, so that people can get a good grasp of what the items are, because it's definitely not expenses that SCI is paying of 5.486 million. So I just wanted to clarify that, because I know that question was asked on the last earnings call and I fumbled it. I couldn't answer it properly. So now I think I have, and if I haven't, you can send me an email and I'll send you a written response to it. Still no questions? Are we sure that we all the portals that we take questions to?
Right, so the Q&A tab is working. We do have one from YouTube currently. You touched on it briefly, Jason, but Jerome is asking, what's the timeline for Accrescent to start paying a dividend to SCI?
Last time I avoided that question, answering that question directly. But I'm gonna try and be a little bit clear. I think this will happen within the course of 2025. Yeah, that's the best way I can answer it. So if I would hazard a guess, I would say we more than likely will start maybe when at the end of the financial year, which is June. So just take that under advisement. That would be just if I were to give you some color. I don't want to tell you something and then backtrack on it, but I would think that more than likely will be the best timing. Doing so after we have audited financials, and yeah. So I would say if I were to say that, then that would mean that effectively for SCI shareholders, that would mean the dividend that is normally paid in closer to the end of the calendar year, which is November dividend.
Okay, thank you for that, Jason. Thank you for the clarity you've provided during the walkthrough this morning. Still not seeing any questions, but if you have any thoughts after engaging with the presentation and re-listening the recording, which will be available on YouTube and the SYGNUS Group website, you can share at info@sygnusgroup.com and we'll get back to your query. So a special thank you once again for your time. I'd like to wish a productive week to everyone. Goodbye.
Thank you, everyone.